Hi, hello everyone. This is Ijaz Khan, and in this lecture, we will be covering working capital management, investing, and financing strategies. Before we go to the investing and financing strategies, let's first discuss what is working capital. Working capital is basically the amount of capital that a business needs to run its day to day activities like cash, receivables, inventory, prepayments. So these current assets will be required for a business to run its day-to-day activities. So let's suppose that a business needs $30,000 of cash, $50,000 of receivables, $80,000 of inventory, and $20,000 of prepayments. So the total current assets that this business will need will be $180,000. And let's now suppose that out of $80,000 inventory, $30,000 worth of inventory may be obtained through credit purchases. So we call them account payable. So of the $180,000 of total current assets required for the business, if $30,000 will be financed through current liability, then it will mean that the business still needs $150,000 investment to run day-to-day activities of the business, and that is called working capital. Now, how the company is going to manage this working capital? Now, does a company needs why does a company need working capital management? Working capital management is basically the management of investment in the current assets and the sources of financing these investments in such a way that the company makes enough profits and is at the same time liquid so that it is able to meet its liabilities on time. Because if a company invests too much into its current assets, it means that it will have less investment available for non-current assets from which it can generate profits. So if it keeps more capital into current assets, it will have to earn less profits. On the other side, if it keeps less capital into its current assets and invest more into its non-current assets, then it will be making profits, but at the same time, it will be putting its liquidity position at stake, as when the liabilities may fall due, it may not have sufficient current assets to pay off its debts. So the basic objective of working capital management is to create a balance between profitability and liquidity. And this working capital management or this objective will be achieved through investing decisions and financing decisions. That is deciding at what level should the company invest in its current assets so that it is making enough profits and is liquid at the same time. And also the financing side, that is from where to bring that investment into current assets. For example, if the company has decided to invest $180,000 into its current assets, now from where this company is going to finance these $180,000, either through short-term sources or through long-term sources. So this is what the company has to decide. So this will be called the financing side of the working capital. So let's first discuss the investing side of the working capital management, how the company will decide about the level of investment in its current assets, like cash, receivables, inventory, prepayments. Now the company has to decide how much to invest into its current assets. Now, what factors will help the company to decide the level of investment in its working capital? The nature of the business. It's very important to look at the nature of the business, because if you are formulating this working capital strategy for a manufacturing business, you will be having more investment in your working capital. That is because you will be needing raw material inventory. You may have to invest in your work in process inventory, and then you'll have to have investment in your finished goods inventory. So this will increase the total level of investment in a in a business. On the other hand, if you are running a service business, you may not have that much of investment required, as you may not have raw material or very immaterial inventory. You will not have any investment in your work in process, and similarly, you will have no investment in your finished goods. So almost you will have a little inventory in which you have to invest. Then it's the other factor will be uncertainty in supplier deliveries. For example, if you're very much certain of how when your supplier is going to deliver your raw material, you will not be in, investing too much in your inventory because you're very much sure of when will the supplier be delivering. But in case your supplier is not reliable and you're not sure of when he is going to deliver, the lead time may fluctuate. In that case, for the safety's sake, you may keep a higher level of inventory. The overall level of activity of the business. Of course, if you are managing uh, the working capital for a big business, then you'll have to invest more into your working capital. But on the other side, if it's a small business, you don't have to keep much into your working capital. The company's credit policy, if the company is too much generous in awarding its credit to its customers, then it will be investing too much in its receivables and therefore increasing its total working capital requirement. The credit policy of supplier, as we discussed earlier, that your total working capital requirement will be reduced by the account payables, which means that if you get more inventory on credit, it will reduce your requirement of working capital. So if your supplier is generous and he gives you a lot of inventory on credit, you will be needing less amount of working capital investment. But if, on the other side, if the supplier it does not the supplier does not offer any credit terms or lower credit terms, then you will have to invest more from your own self into the business. The length of the operating cycle, we'll discuss it when we'll be discussing the cash operating cycle. And the management attitude to risk, it's again very important to look at what attitude does the management show towards uh, the working capital. Uh, let's discuss the management attitudes to risk. Uh, the management may be aggressive or it may be conservative. Now, when we say aggressive management attitude, it means that the management will be too much into profitability and it will be ready to take the risk on part of the liquidity. So it means that the management, if it has the aggressive policy, it will keep lower level of cash, lower level of receivables, lower level of inventory, and it will try to invest its capital into non-current assets and earn more and more profits. Since the management will be aggressive, there will be high risk that the company may fail to pay its debts on time as it will have less level of liquid assets. On the other side, a conservative approach will be that management will be investing too much in its liquid assets so that it's sure that it can meet its liabilities on time. On the other hand, it will have to lose profitability since it will have more investments in a cash in hand, inventory or receivables. Since the current assets they do not make the company earn profits, therefore the company will be making lower profits, but at the same time will have low risk. Now let's move towards the financing side of the working capital, whether the business will be investing in the working capital through short-term source of finance or it will be investing through long-term source of finance. Now, before we actually move towards different financing strategies, let's first discuss the working capital requirements of a business. The working capital requirement may be at a permanent level or it may be at fluctuating. The permanent working capital requirement is basically the minimum working capital required for a business to run on a day-to-day basis throughout the year. For example, the minimum level of cash that it needs throughout the year, the minimum level of inventories that it will need throughout the year, and the minimum of receivable that it will have to have throughout the year in order to run day-to-day operations. So that's called the permanent working capital requirement. The fluctuating working capital is basically the increase or decrease in the requirement of the working capital during the year beyond the permanent working capital. And this basically happens when a business is a seasonal business. So in a peak season, the management will have to keep more inventory, more receivables, and it will have to hold more cash. But on the off-peak times, these levels will reduce to a minimum level. So this is called the fluctuating working capital. So to finance the working capital, there will be three strategies, unlike the investing strategies where there were only two strategies, the aggressive one and the conservative one. So it's very important in the exam to identify whether the investing side of the working capital has been asked or it's the financing side of the working capital. So the difference between the two is that there we had two strategies and here we have got three strategies: the aggressive, the conservative, and the matching strategies. So let's now first discuss the aggressive strategy. Now, when we were talking about the aggressive strategy of investing side, we were actually discussing how much to invest in the working capital so that the company makes more profit. And now when we talk about aggressive strategy with regards to financing side of the working capital, then again the objective will be to earn more profit. But here the decision will be through which source should the company invest in the working capital so that it makes more profit. Remember one thing, that short-term source of finance is always a cheaper source of finance as compared to longer source of finance. And when we will be discussing sources of finances, we will be discussing this in detail. So when we talk about aggressive strategy, remember the shift will be towards profitability, and therefore the reliance under the aggressive strategy will be on the short-term source of financing, which will cost less to the company and hence will make the company earn more profits. So in aggressive strategy, the fluctuating working capital will always be financed through short-term source, whereas the permanent working capital will significantly be financed through short-term source, and a very minimum level of permanent working capital will be financed through a long-term source. So you can clearly see that in this strategy, the inclination of the management will be towards short-term finance so that it earns more. But at the same time, since the reliance on the short-term finance will be more, the risk will also be higher because the company be will have to pay back its debts in the near future, and it may create risk for the business to meet its liabilities on time. In the conservative strategy, the reliance will be on the long-term source of finance because the conservative strategy is basically the risk avoidance strategy. The business will try to avoid the risk as much as possible. So the fluctuating working capital will be a significant portion of the fluctuating working capital will be financed through long term, and a very short portion of the fluctuating working capital will be financed through short-term source of finance, and the permanent working capital will be 100% financed through long-term source so that the company uh, is not at risk. But since the company is taking low risk, it will be earning low profits as well. The matching strategy is that the fluctuating working capital will be completely financed through short-term source of finance, and the permanent working capital will be financed through long-term source of finance, and therefore it is called matching strategy, as the source of finance is matched with the requirement of the working capital. Since the fluctuating working capital will not be required throughout the year, therefore it will be financed through short-term source of finance whenever it is required. Whereas the permanent working capital, which is the permanent requirement of a business, will be financed through long-term source, as it will be a permanent requirement for the business. Therefore, it will be financed through long-term source. And that's why it is called matching strategy. Uh, I'm sorry for the heading, which still says it's a conservative strategy, but it's a matching strategy. In the next video, we will be discussing about the cash operating cycle, how to manage the cash operating cycle, and how to calculate the cash operating cycle. Thank you for watching Easy Study.